as I record today's video, the stock market just hit another all-time high. And that's great to see, and we all celebrate it. But it's also a great time to look at our asset allocation, to look at our investments, and to make sure that we're on the right path. And in today's video, I'm going to share with you 3 things that I think you absolutely should do when the market's at an all-time high like it is right now. The first one is I implore you to critically look at your asset allocation and really ask yourself, do I have the right mix of stocks and bonds? Unfortunately, a feature of the stock market, while it's at an all-time high today, probably sometime in the next 10 or 20 years, it'll hit a scary low. It'll go through a big correction. Hopefully not, but probably yes. And the time to look at your asset allocation and to make sure you're not overexposed to stocks, to make sure you're not overexposed to equity, to make sure that you can withstand scary days when they happen again, not if, but when. I don't know the date, but it's just a feature of the stock market. I know it's going to happen. There will be another scary period. And the time to ask yourself, am I over allocated to stocks? The time to ask yourself that is when your stocks are at all-time highs. And if you do make a change, you're making a change and you're taking chips off the table at an attractive price. One of the secrets to being a successful long-term investor is avoiding being a forced seller in a down market. You don't mind being an educated and a patient seller in an up market. And that's what you have the opportunity to do today. So the first thing that I'd like you to think about is your asset allocation, and do you have your asset allocation correct? The second thing that I want you to think about is when stock prices are high, to the extent you have any charitable intents, there's charities that you like to support, this can be a great time to open up a tool that's called a donor advised fund. And a donor advised fund is custodians like Schwab and Fidelity offer tools like this. It's a special account where you can gift appreciated stock into this special account. You get your charitable write-off, but you don't have to decide where that money is ultimately going to go. You get to separate those. Now, it has to be an official charity. It has to be recognized by the IRS as an official charity. Most churches, religious organizations are going to qualify. Things like the Red Cross are going to qualify. Many of the donations that we all make are going to qualify, but you can talk to Fidelity, you can talk to Schwab about that. But the advantage of gifting appreciated stock that you've held over a year, and that's important, so that it gets long-term capital gains treatment. It has to qualify for long-term capital gains, or instead of you getting the charitable write-off for the full market value of it today, if you've held that position less than a year, if it doesn't qualify as a long-term capital gain, you can only write off its cost basis. Now, this is not financial advice, and I'm not an accountant. So you should definitely see an accountant and make sure that how these rules are going to apply to you. But a donor advised fund can be a very powerful tool, and it's even more powerful when stocks are at highs. So, and I'm going through this list. The first one, making sure your asset allocation is super important. The donor advised fund is not going to apply to everybody, right? If you're not currently making charitable donations, if it's not something that's on your radar screen, you do you. This channel doesn't make moral judgments as to whether we should make donations to charities or not. But for those of us that are, a donor advised fund is something that a lot of people don't know about. You should know about. And the value of donating appreciated stock is worth more when the stock price is high, right? Because just the value of it's high. And also, it would be a shame for you to sell that position, for you to pay tax on that position, and then donate cash, When you can donate it to the charity, and if it's a charity that's recognized by the IRS, the charity can sell it without paying any tax on it. So a lot of folks are going to find themselves in the 15 or the 20% tax bracket with appreciated stocks by the time they figure out federal and state. So if you have $100, you might only be donating $80 to the charity after taxes. Where if you donate the appreciated stock directly to the charity can sell it, and now they have $100. So that's why it's so powerful. And then the donor advised fund lets you take advantage of opportunities like we're in now, where the stock market's at an all-time high. You can take advantage of that even if you don't know who you're going to give that money to or how much you want to give to that charity. And you can separate these by years. So it's a super powerful tool. I want to make sure you know about it. Another super powerful tool is we talked about making sure your long-term allocation is right. But oftentimes, even if your long-term allocation is correct, let's say you were 60% in the stock market, 60% in the stock market, 40% in bonds. Well, when the stock market does well, you might have more exposure to stocks now than what you thought you did. So it's important that every year you look at it and you rebalance your stocks and bonds just to make sure that it's staying in the general area, the general percentage that you want it to stay in. So getting that right, it's very easy in good times for you to be over allocated to stocks, and then in bad times, just before the market's going to start going up again, because the value of your stocks went down, you're under allocated. Okay, so that's three things. I'm going to give you a bonus. Again, none of this is tax advice. I just want this to be on your radar screen. The next one is kind of taxy. So I really do. This is just put it on your radar screen. You research it on your own. But that is the limit for long-term capital gains, how much money you can make and still not be paying taxes on long-term capital gains. For a couple that's married filing jointly, your adjusted gross income can be a little over $90,000 a year and not pay any tax, federal tax, on long-term capital gains. And if you look at the standard deduction for a couple married filing jointly, that's like $30,000. Remember, the $90,000 limit is on your adjusted gross income, which is your salary less your deduction. So a married couple can make a little over $120,000 a year. Take that standard deduction, which brings your AGI down to $90,000, roughly. I'm just giving rough numbers here. And let's say $10,000 or $20,000 of that income was long-term capital gains. Well, you're going to get that for free. So without paying federal income tax. So look at the tax brackets, talk to an accountant about your situation, and you might be able to actually harvest long-term capital gains when you're at the 0% bracket. So it's something definitely worth talking to your accountant about. It's also worth watching this video here where I talk about 5 reasons to retire as soon as you can. You're working hard for your money. I want you to enjoy it, so I'll see you in this video. Thanks for watching this one. Bye-bye.